The topic for this panel is quite broad, and it's really just to try and set the scene. That hopefully we can get into some sort of meaty topics. The topic is Hong Kong, Mainland China, and global markets: perspectives of industry, the exchange, and regulators. And before I just want to introduce the subject in a little bit more detail, but not for too long. But firstly, I just want to introduce the panelists properly. Firstly, we have from the industry, of course, Jing Ulrich, who's too long for me here, who is Managing Director and Vice Chair of Asia Pacific at JP Morgan. From the regulatory community, you have myself and Keith Lui at the end there, who is Executive Director for Supervision of Markets in the SFC. We have quasi-regulatory. We have a former central banker and my former boss as SFC chairman some 15 years ago, Andrew Sheng. And then finally, someone who will need no introduction at all is Charles Lee, CEO of the Stock Exchange in Hong Kong. Right, some thoughts just to kick off the panel. Now, I think as Carlson indicated, things have changed a great deal since the first and last forum that we hosted back in early 2014. And my view is events since then, and in particular events in mainland markets, have really been unprecedented. And I suppose the latest event has been the appointment of Liu Shiyu as the new chair of our counterpart, the CSRC, which was announced on Saturday. Chairman Zhao Gang stepping down. But I just want to kind of go through a little bit of a refresher to set the context as to what has really happened over that period, and in particular events that are relevant to us in the SFC. Now, of course, from mid-2014, there was a very, very, very large run-up in the mainland markets. And we all know that at the time, there was a pretty explicit goal around the relevance of markets to reduce the debt burden in the mainland, to fund what was seen to be more productive enterprises, and also to enable markets and competition to play what was, I think, sort of famous phrase, which is a decisive role in the economy. And in particular, it was clear that there was an ambition to allow markets to price investment risk, to enable domestic savings to be deployed more efficiently. Now, of course, that all changed in the summer of 2015, last year. We did have a market crash, and that was in part to do with the extremely large amount of official and unofficial margin finance in the system, and also to an extent valuations in the markets, which we again all know were very, very high. The index dropped around 40%, that's more than Japan's GDP, and turnover also plummeted. And then, of course, in the second half of 2015 and now into this year, there were multiple interventions in the markets in an attempt to stabilize things. I mean, highlights of those interventions include bans on share sales, bans on short sales, suspensions of trading of companies. At one point, more than 50% of the companies in the A-share markets were suspended from trading. Restrictions in the futures market, which effectively meant that a market that experienced around 2 billion RMB turnover reduced to a very, very small fraction of that quite quickly over the summer. There was the much covered buying program by the what was tagged the national team. And on top of that, you will have seen formal investigations of firms, mainly brokerages, on the mainland to do with the way in which they participated in the aftermath. And then finally, at the beginning of this year, the introduction of circuit breakers into the mainland market on a Monday and the withdrawal of those circuit breakers on a Thursday, the following Thursday, 4 days later. So all of that, I think, demonstrates that what did happen then was unprecedented. And in the meantime, of course, from August, we had the devaluation of the currency, and we have a subsequent currency story, which is still continuing. And we've obviously had, as Carlson mentioned, weaker China data, particularly around GDP and manufacturing PMI, although services PMI has gone up. The commodity supercycle seems to be well and truly over. And what is really interesting is that China concerns, China issues have featured in overseas, and in particular US and now European, monetary policy decisions, which is a real first. That's never, ever happened before. And it's explicit. Now, Hong Kong, that's all about mainland China, but the reason we're talking about this is because clearly we are joined to the hip. Now, of course, during this period, the Hong Kong markets did function without interruption. And because of the way in which the markets operate here, there was no need for any special measures. But having said that, the market has fallen roughly 1/3. And I think what is striking is much commented on is that the disparity between the prices in the A-share market and the prices in the H-share market is still quite stark. And the PE in the index here, particularly when it comes to the H-share index here, is now below 6, which on any basis is very, very, very low. And you may have seen just a few weeks ago, it became clear that the PE in the markets here was dropping below NAV on an aggregate basis. So the issues for Hong Kong, which we really want to get into here, connected with the mainland markets, firstly is a dominant theme since our first forum has been around connectivity with the mainland markets, with Stock Connect, and more recently mutual recognition of funds, both of which have been launched. There is, I think, still, not surprisingly, an underlying view, both here and in the mainland, that to progress and to stay on track, this is all around an ambition, so far as the mainland markets are concerned, to attract greater participation from institutional overseas investors, and also at the same time a willingness, certainly in the longer term, to allow mainland investors to put savings to work outside the mainland. And in that context, viewing Hong Kong as a dominant connector around that ambition, both ways. Now, implications for this panel, and some of the questions I think which it raises in our minds, certainly when we were chatting about this beforehand. Firstly, for the exchange, and this is Charles, are we putting all our eggs in one basket, basically? For regulators, we end up inevitably managing increasingly complex risks, and we need to ensure that integration between the markets is matched by a high level of regulatory cooperation. And the question is that achievable? And for industry, how do you participate in a rapidly changing environment? And for Hong Kong, how does it really position itself as an international financial center, as a connector or super connector, or as a risk management center for China, or something else? So having said that, I want to get firstly, we'll go to the panelists one by one, just to get some initial thoughts of around 5 minutes each, and then we'll open it up to a discussion. And at the end, we'll be taking questions from the audience to finish off with. So without further ado, can I pass over to Andrew first?
Thank you very much, Ashley. I want to thank you and Carlson for inviting me to this wonderful second regulatory forum. I'm now an academic, so I'm not in the front lines, I'm not in the market, I just give advice. And advice is free, consequences are another thing. But anyway, the question that was posed to me was to put this in context. And what the context really is that finance has grown far faster than the real economy in the last 2 decades. We've now reached a stage in which pushing the finance string may be creating even more debt overhang. The world is over-leveraged. The world is now facing secular stagnation. This is not good news. We now have the advanced countries growing at best at 2% and complaining about China and India growing at 6 to 7%, which seems to be very, very anomalous. People are very pessimistic about, process going forward. What is the interrelationship with stock markets? The answer is that the only way you can get out of deleveraging, or the 2 ways, is as follows. One is that you boost the equity markets, which was exactly the Chinese intention. There may have been missteps along the way, but the Chinese system realized that it was too bank-focused and needed to boost the capital market to recapitalize the system and regenerate real growth in the system. The second way, of course, is to restructure the whole debt system by restructuring borrowers and rewriting the national balance sheet, both of which are not easy, and that's exactly what we are faced with. Now, the key question going forward, as we've seen that context, is are we looking at the world of a glass half full or half empty? The way the markets are behaving at the present moment is that everybody looking at half empty, particularly on mainland China. And this seems to me very strange because if you look at the good news, which is I would not like to use the word collapse, but cheap oil and cheap commodities can only be good for China and actually for the world. It's not good for oil producers, but it is actually very good news because it would allow a transfer of wealth from resource people to the producers of this world and hopefully for the consumers. And that would generate long-term growth. So to a large extent, the Chinese are now facing a very major structural adjustment away from a manufacturing base towards a service economy following advanced countries. And then the key question is, how do you get the financial system to finance that transition, right? And can you do it through financial engineering, or do you do through real engineering? Now, look at the way the Chinese look at this problem. You need to focus on pushing infrastructure, because China still needs a lot of infrastructure. You need to push funding for SMEs, which is exactly what they're trying to do through fintech, multi-level capital markets, and then you need to use technology to generate growth in the services sector, which will then revive growth. And if China goes back to a stable 6 to 7% growth rate for a $10 trillion economy, which is roughly already 16, 17% of global economy, that can be contributing not only to global stability, but also to Hong Kong prosperity. And Hong Kong has a major, role to play in this regard. But of course, we all learn, and I think mistakes have been made. Nobody doesn't see this. The philosophical question that I really want to pose for regulators is this, and this is where I personally disagree with a lot of things that is going on international financial regulation. Number one, international financial regulation has, after the crisis, been too complex. It has become so complex, it's micromanaging the industry, point number one. The second question is, can micro-prudential lead to macro-prudential or macro-imprudential? That means if you don't allow small instability, do you create the large instability? That is an intellectual and a practical question that the neat boxes in which, I'm sorry to say, the FSBs of this world, in thinking about this problem, I think has got it wrong. So to a large extent, Carlson made the challenge. Should Asia think for itself in this regard? And I say yes, because we're still the growth industry. We're still the growth sector in the world. We are net lenders to the world. We're not net borrowers. And if we are net lenders to the world, we have sufficient savings and growth to get us out of the secular stagnation. And that's why I think the major reforms that are ongoing in China, in India, in ASEAN, this growth region in Asia, is so critical. And I think Hong Kong can play a very major role. The industry can play a very major role. This is no longer about best practice. The best is the enemy of the good. What we need to concentrate now is what is good for the world. It's not necessarily good for everybody, but I think we need to now get that right balance, about between macro and micro in such a way, knowing that in that road towards the new 21st century service-driven, more green, clean, lean economy, a lot of mistakes will be made, a lot of bumps will be along the way, but we still need to go for what I consider to be best fit. What are the rules of the world that best fit our situation in Asia? And it is very different for different countries and different economies. So what fits the mainland does not necessarily fit what is in Hong Kong. What is Hong Kong fits Hong Kong doesn't necessarily fit what is the mainland. Let's not try to apply one-size-fits-all rules. Let's be much more open-minded, flexible, and learn as we go, and keep an open mind as how to deal with what is the most complex, again, as Carlson says, the most complex, fast-moving, changing environment in which we all have to live through over the next 24 months, if not the next decade. Thank you.
Thanks, Andrew. Right, now turning to Charles. Andrew just said that Hong Kong must and can play a major role. So, Charles.
Yeah, thank you. I think Ashley used the analogy of the egg in the basket. And I think the real question, really three questions that is being asked is, are we putting too many eggs into one basket, which is China? And if we answer that question and negatively, then we want to put more eggs in that basket, and then which eggs to put into which basket. And then lastly is really understand how the eggs in baskets are different, and so that we actually put them properly, so that we get the best out of it for Hong Kong and avoid the worst. And that's obviously a big challenge. So at the beginning, the answer to are we putting too much into China? Clearly people miss the point. I think most of the people in this room would understand that we need to be China in order to be international, and we need to be international in order to be China. We will never really, we will never be able to be anything other than a great China translator for international and international translator for China. So our overall mission should be that for our Chinese clients, whether you need money or whether you invest money, we're your best exchange of choice, international exchange of choice. But for our international clients, whether you're investors or whether you're users of capital, we're your best and we're your China exchange of choice in order for you to reach your China aspirations. And we have to be right in that middle. And so, our backs is in China to be international, and our basket have to be international in order to get the Chinese eggs in there. So that's really, in our mind, we do not apologize for wanting to have that focus, and because we all know that we are not there to be another Chinese exchange. and we're trying to be their international exchange of choice. But then, having said that, and having agreed, assume we all agree with that, then the issue becomes as to which basket you put what eggs into it. Historically, we have only equity business in this market largely, and we need to really look at our clients there and look at today whether equity is still the right business to be in. If it is there anything has changed significantly in the equity business that we need to really adopt significant different approaches? And do we also have other baskets? Do we have a basket of commodities? Do we have a basket of fixed income and currency? And are those baskets strong enough for us to begin to make investment and put our eggs into it? And I think here, Andrew made an excellent point that we all need to fully understand that today, our biggest home market, which is China, and largely, similarly in that vein in Asia, we are net lenders, which means that now we are the one who have the resources to lend or invest, rather than we are the destination of capital, and that translates into very significant differences as to how we run our markets here. So I think now let's look at the three baskets that we are now looking at aggressively to determine what's the best course of action for us to take going forward. Let's look at equity. In the equity space, we are, an equity market, for 20-some, 30 years. And, but fundamental changes have taken place. We have full clients in that particular space, theoretically. We have a Chinese issuers of capital. We have Chinese users of capital. We have Chinese issuers who needs capital. We have Chinese investors who, have capital to invest. We have international investors who want to invest in China, and we have international users of capital who may potentially want Chinese capital. So that's the full clients that Hong Kong has. For the last 20 years, we were doing business with only two clients. It's the Chinese users of capital who have no other places to raise capital. They came to Hong Kong early 90s, and the international investors who are the second client Hong Kong has came to Hong Kong en masse, and we become the capital formation center for China, and that's our business for the last 20 years. That defined our equity business. That is 60-70% of our market cap of companies here are Chinese companies, and over 70% of daily trading is from those Chinese companies. But essentially, we're only doing business for two clients, Chinese users of capital, international investors. Today, as Andrew said, we are now net lenders and net investors. China is no longer a capital importer. It is a capital exporter now. China does not have, it still needs capital. IPOs will still take place, but that's largely because the domestic market is not fully functioning as the provider of capital. So they still come, but that's only on the margins now. And the key change is we need to change our role to become the way to manage Chinese capital into the future. So we now actively are pursuing a different kind of business in equity that we want to bring the Chinese investors for capital into Hong Kong, which will then allow us to get the last customer that we have, which is the international users of capital like Apple, Disney. They have no reason to be in Hong Kong today, but if we are able to bring them access to the Chinese domestic investor base through Connect or otherwise, then we will get that last customer into Hong Kong. So now our mission is to get the two last customers, Chinese investors, international users of capital, into Hong Kong, and then we'll be done. So our equity business, particularly on the cash equity business, success requires us to be innovatively looking forward, finding ways to bring that two together. Second part of our huge equity potential is also changing. The domestic capital market, we have seen that it's gone through a tremendous amount of difficulties. And one of the key contradictions they have is that they cannot run a largely retail-driven market at the same time have a strong derivative market with modern weapons of potential mass destruction and production at the same time. So now they cut the futures market, they cut a lot of the short selling, they cut a lot of things that normally you have to have full capital market. Then as Ashley, very, pointed out in his vision, that should we also become the offshore risk management center for China, so that if it's too risky for them to have all these modern weapons of financial instruments, but those are necessary instruments in order for China to become a modern market, then could we find them a way to offshore risk manage in Hong Kong while maintaining a more stable and more reliable and more sort of a secured growth base for the domestic investors. So that's really something that we wanted. So in equity, international issuers of capital coming access to domestic investors is one big goal. Second is offshore risk management center, as Ashley correctly pointed out. I don't have time to really look at the other two baskets, which is commodities and fixed income and currency. But the key issue there is that Hong Kong is a small market. We will never be able to develop a fully kind of a commodity and fixed income market on our own. We have to find ways to make sure that we are the pricing center, we're the pricing influence aggregator for China's commodities, because they are the biggest consumers of commodities, but it's the biggest volume taker and the price taker. Hong Kong can help them achieve that pricing power so that they're not only the volume taker, they're also the price maker. But we have to do that. We have to do it differently. We can't sit in Hong Kong to do it. So our commodity strategy is essentially treating commodity like equity. This market knows equity better than commodities. So equity, you have to have a cash market, which is the IPO. Then you have to have a secondary market trading, and then you have to have derivatives. Most commodity market, the derivative market. So what we're trying to do here is to go into China, build an offshore spot commodity market platform. That's almost like creating an IPO market for commodities. Because the commodities, unlike H-shares, they can come to Hong Kong. Commodities cannot fly to Hong Kong on their own or float to Hong Kong on their own. We go in there, create an IPO market, pricing center for spot commodities. That will in turn allow a lot of secondary trading or forward trading. Ultimately, there will be price benchmarks generated, and then we can do offshore futurization in Hong Kong or futurization in China. That will allow us to become a true global commodity center. Currency obviously have a lot to do with renminbi, and I think my time is up on that. Thank you.
Thank you, Charles. I think that was a great potted version of the vision you have for the exchange over the next few years. All I'd say is that clearly, against the background of the last few months in the domestic markets in China, this is potentially a major turning point for Hong Kong as an international financial market. And I think in our view, as significant as the start of H-shares back in, was it 1993? Okay, now over to Keith. Keith and his division, Supervision of Markets, spend the vast majority of their time regulating the exchange. So Keith is extremely well known to Charles, and particularly around new products and the risk management aspects of exchange business. So over to Keith for some thoughts, again, from a perspective of a Hong Kong regulator.
Okay, thank you, Ashley. I would like to using this occasion to just to say a few words about from the perspective of our regulators. Okay. We listened to Ashley paint the global pictures, right? The very complicated global pictures, right? Now we are facing, and also Andrew described the inconsistency in terms of global financial regulations. So as our regulators, we always ask ourselves, how are we going to navigate in this complicated turbulent world, right? What are the guiding principles for us, right? We need to have some kind of anchors for our actions. Okay. So to me, I think there are three things very much dear to the heart of our regulators. Okay. So we have to stick to this three things. The first is protecting investors or investor protections. The second one is maintaining fair and orderly market. The third one is reducing systemic risk. They seem very simple things, but actually those are the things we consider on a day-to-day basis. Okay. And these are not, these are global standards. Okay, they have been devised, after the Asian financial crisis by IOSCO in 1998. And one of the author of this principle, Andrew Porter, is in our audience. I still find this principle very useful to me. They are entrenching in our SFO. Okay, so this is the guiding principle for us to act. Okay, so I just mentioned this one for all our colleagues and all the audience here, in particular market participants, how we look at things. I mean, if you're using this free principle to measure against, what happened in global financial crisis, in 2008, and the China, stock market gyration. So you see the deficiency and the weakness, we saw, in our systems when we measured, the reality vis-a-vis these principles. That means there's a lot of things we need to continue to do. Okay. It's a simple principle, but very powerful. Now, the second thing I want to mention is about China. I mean, it's very obvious. China is the world's second largest economy and the largest emerging market. That's one part of it. It has a very huge size. The second part is pursuing economic and financial reforms and opening policy have been and always be China's top priorities. Okay. And the government stated very clearly in the 13th five-year plan. So when one combines the size of China together with the speed of changes, reform, the law of physics tells you the energy you're going to release will be tremendous when the two things combine together, hit the right directions. So if we translate into financial language, what it means we need to be careful or watch out the China risk. Okay. As a regulator, we have a tendency to be more conservative, to look at the downside risk, because the upside potential will take care of itself. The market will enjoy it. So we, as a regulator, we constantly, look at this issue. This is not new, but given the pace of China's, reform, right? They have set a timeline for 2020 to be a key milestone for their GDP to double up again. So in the next 5 years will be critical for all of us. Okay, in particular Hong Kong, we are so close to it. So my message is this: facing with this, coming changes, tremendous changes, right? And also recognize the further integration of the Hong Kong and mainland markets. As our regulators, we need to stay focused because there are so many things can detract us. We need to go back to the basics. And the basics are the three things I mentioned earlier. Now I'll go back another, just because of the time, probably still have a little bit more time. Go back to Ashley's question about, in this type of environment, we need to have high level of cooperation, good cooperation with the CSRC. Now, one of the things has changed since the Stock Connect is, as Charles mentioned earlier, I mean, we have been fundraising center for China for 20-something years, right? But it's one way. We raise funds. We are the offshore fundraising center for them. So the incentive behind for enforcement cooperation, regular cooperation is different. Okay, we want them to do something for us. But now with Stock Connect, the market's neutral. Okay, China has been opening up the market, so there's a lot, close to 70 billion US dollar, QFII type of quota into China. But more, we are looking to the outflow from China. Right? The early speaker talked about China is the net exporter of capital. So that will be the wave coming in the next decades. When you look at the consumer, people coming to Hong Kong, Australia, Japan to buy up consumer goods. So you can see the power of China. So I think in financial market, there will be a time, this will happen to us as well. So we need to prepare for that one. And because of the mutual thing, that's important. So that creates an incentive for both regulators to work with each other genuinely. right? And in a way to resolve their problems. And the final thing, I just want to comment, Andrew's point about micro and macro imbalance. Yeah, I mean, the global regulation, of course, since 2008, some aspect of it has been quite, micro, quite prescriptive, particularly like, Basel III. I mean, like OTC derivative. I mean, there are reasons for that. I mean, because country concerned about competitions, right? Regular arbitrage. But I agree. I mean, some of the area has been too micro. So that's why from time to time we need to go back to the higher principles to guide our decision making and policy changes. So I think the thing is, Andrew also mentioned there's no one size fit all. We also agree, right? But to a high level, there are certain high level principles I think we can all stick to and focus on them. And that will give us carry us quite a long way forward. Thank you.
Thanks, Keith. Just one comment on that, and also goes back to some points that Charles made, and also Andrew. From our perspective in the SFC, if you look at our sort of worldview at the moment, in one respect, we are spending a fair amount of time dealing with the ambition of global regulators, which is really code for the Financial Stability Board and other US and EU regulators, to export the solutions they've landed on to the financial crisis to Asia, and the justification given for that is by and large regulatory arbitrage. In other words, the fear that business would move to Asia to evade these rules. And the point we have been making pretty strongly is that it isn't one size fits all, number one. Number two, one could question the basis of some of these rules in any event. Not all of them by any means. As Keith says, many of them are dealing with sort of serious systemic issues, but certainly not all of the rules are totally justifiable. And that's a conversation which is quite difficult to have. So in one respect, we're kind of, to an extent, we're pushing back on the export of these global rules into Asia, and increasingly quite successfully. On the other hand, clearly the single largest issue that we deal with, quite rightly, is our connectivity with mainland China from a regulator's perspective. And Charles has talked about it from the stock exchange's perspective, and has been obviously, he has a very clear vision, and the stock exchange has a very clear vision around that. From our perspective, it is absolutely vital that the degree of connectivity between our two markets are matched by a degree of regulatory cooperation. And because of the mutuality now of those connections, not just listings in Hong Kong, but now mutuality, the incentives to cooperate are much higher. So in one end, we're kind of pushing back, and on the other end, with China, we're advocating, and we are succeeding, in fact, with far greater cooperation. So that's really kind of at a high level, the world as we see it. Now, really importantly, let's turn to the industry, because we're academics and former regulators, we're stock exchange, which provide the platform for industry to trade on, but we need to hear the industry's voice. So Jing, over to you.
Thank you, Ashley. Thank you very much to you and Carlson for inviting me to this great forum. So in the next couple of minutes, I just want to highlight what the industry is telling us. So in our daily work, we communicate with many international investors on a daily basis. So when it comes to Hong Kong and China, there are two main issues often raised by global institutions. The first issue, or the first concern, really is what's happening to China's debt levels. Leverage ratios have gone from 160% back in 2007 to about 250%. So how do we resolve this issue? What role can the capital markets play to help China reduce leverage and increase corporate profitability? The second issue that I often hear from global institutions is the difficulty of accessing the mainland market, and also the disconnect between China's overall global economic stature and the size and the openness of its capital market. So there's indeed a disconnect. We all know the Chinese economy is $10.5 trillion today, the second largest in the world, but the financial market is still relatively young and relatively underdeveloped. And if you look at the stock market, it is certainly the most volatile in the world. Also, institutional participation is very low, and it is not yet fully open to foreign investors. Even for the bond market, even though the Chinese bond market has become the third largest in the world after the US and Japan, there is very minimal foreign institutional participation. These days, I think the positive news is that many Chinese companies are beginning to source financing from the bond market. 10, 15 years ago, all the financing came from banks and largely state banks. So today, out of 10 yuan of financing each company gets, on average, 2 actually comes from the bond market, which is very good. However, institutional participation is high, but it's mostly domestic institutional participation. Foreign investors, with the exception of a few central banks and sovereign wealth funds, really cannot access the RMB bond market effectively. So these are the main issues that I hear often from institutional investors from around the world. But most importantly, how do we resolve these issues? And what is the role of Hong Kong to help China resolve these issues? Now, if you look at the first issue, which is the debt overhang, we know, in the last several years, state banks disperse a lot of credit to a lot of local government-supported entities, as well as state-owned companies. Now, this debt overhang must be removed, and the capital markets need to play a much bigger role in financial intermediation. But to get the capital market to play a bigger role, first of all, we need to have effective macroeconomic management of the country as a whole. So monetary policy, fiscal policy, but also a transparent communication strategy from the leadership in China to the market, so that the market participants are clear about the short-term and long-term plans for various types of reforms. In times of volatility like this, the inclination is to roll back some of the structural reforms, but actually the reverse should happen. Particularly when the economy is facing very tough challenges today, we need to have some painful structural reforms taking place. Also, some of the supply side reforms the leadership has been discussing. And of course, next week, we have the National People's Congress convening in Beijing. So hopefully, some of the policies will come out during those discussions. Plus, this week's meeting in Shanghai of finance ministers and central bank governors for G20, hopefully there'll be more clarity on the macro policies. Now, when it comes to the capital markets, I think the leadership in China has clearly a very long to-do list, including establishing a sound regulatory framework, establishing a market infrastructure that's fair, and also really allowing more foreign participation in China's equity market and bond market. But when it comes to the bond market, we need to ensure China's domestic credit rating is on a par with international rating. These days, it is not the case yet because most of Chinese credit is AAA rated. So it's very difficult for institutional investors to differentiate what's a true AAA, what is not a true AAA. Now, but also, think about the bond market, right? It's grown so big in the last several years. Now, to ensure the Chinese bond market stays liquid and efficient, we need to first have a liquid domestic government bond market, because that would help create a pricing benchmark for other types of bonds, including corporate bonds. So there's a lot of things to do for the Chinese leadership. But in this ongoing reform program, what can Hong Kong do? What are Hong Kong's true advantages to help China in its ongoing financial market reform? We all know Hong Kong is enjoying a free and flexible market. It is well regulated. There's a currency in Hong Kong that's freely convertible. And also, capital flows in and out of China are becoming freer. And importantly, there's independent judiciary and a business-friendly environment here in Hong Kong. And more Chinese enterprises, of course, have set up their bases in Hong Kong. And also, I think the transparent corporate governance standards in Hong Kong are a main attraction for global investors. Now, in the coming many years, there are many things for us to look out to. One of the main issues that investors that I talk to focus on is the going global strategy for Chinese companies. If you have noticed, year to date, this is only mid-February, we have more announced M&A transactions overseas on the part of Chinese companies than any time in the past. So this year in 2016, outbound FDI from Chinese companies will well exceed $100 billion. It could top $150 billion. Now, Hong Kong is very well poised to help Chinese companies go global, as Hong Kong is not only a leading offshore R&B center, but also it has a very well-regulated, very well-governed financial market here. So in the coming many years, I would say, Charles made the point earlier, clearly in the past decade, I would say the Hong Kong exchange, the Hong Kong market has benefited from many Chinese companies coming to Hong Kong to list. In the future, if more mainland capital can come to Hong Kong, remember there's $21 trillion of bank deposits in China, largely sitting idle in the banking system, earning minimal returns. If some of that capital can be mobilized to come to Hong Kong to invest in Chinese and international companies, I think Hong Kong, the market here, will become an even more attractive destination for multinational companies to set up base and list here on the exchange. So what can we look forward to in the coming year or two? I would say, hopefully, I'm speaking here on behalf of many international investors. One is the expansion of Stock Connect, perhaps including Shenzhen Connect. We hope sometime in 2016 this will come to fruition. Also, the inclusion of Chinese A shares in MSCI indices. I think there's hope sometime in 2016, MSCI will include, obviously with a partial weighting in the indices for the very first time. That would definitely increase international participation and investments in the Asia market. I think the meeting is coming in June 2016, but there's ongoing consultation between MSCI and institutional investors. Also, in mainland China, as we have a new leadership now, the registration-based IPO system should take shape. Hopefully, this will reduce government intervention and really let the market determine which companies should go public, which companies should list at which prices. The market should determine IPO prices rather than set by regulators. And of course, RMB internationalization. I think this is an ongoing effort on the part of the Chinese leadership. These days, up to 25% of Chinese trade is actually settled in RMB, from zero maybe 15 years ago. But on the capital account, the RMB is not yet freely convertible. So in the coming 5 to 6 years, there's hope the RMB will become much more freely convertible. Therefore, eventually, it will become a reserve currency. These days, 65% of global central bank reserves are still invested in the US dollar. Even though China has a very important economic status in the world, the currency, though, it is by and large uninvestable by international institutions. And I would say there are many other types of investment schemes, whether you have QFII, which has been expanding, QDII, QDII2, RQFI, QDLP. All these, I think, will mean there is substantial upside for both Hong Kong and China. So if Hong Kong and China can work together on these important initiatives, both shorter term and longer term, I think we'll have a win-win situation for both Hong Kong and mainland China. Thank you.
Thank you very much. Right, I think what I would like to do now is pick up on some of the points that you've made about and really focus down on the role of Hong Kong. And I want to turn to Andrew first and just preface that. I think by an observation that certainly until 4 or 5 years ago, with the advent of RQFII and all the reforms since then, Hong Kong was in a relatively simple position whereby we depended by and large to grow our financial center on Chinese businesses, mainland Chinese businesses listing in Hong Kong, which transformed our market utterly over a period of roughly, 20 years or so. I think it seems to us within the SFC that although, as you say, quite rightly, the opportunities are far broader, we're in a far more complex situation now. And in particular, we certainly can't be assured of exclusivity in our relationship with mainland China, which means that both the industry and the public side need to be very clear about what our selling points are, what's our USP going forward, because we simply can't describe that in the way in which you described our USP in that simpler world over that 20-year period. And I just noticed, that I think many others would notice that as a result of a visit by George Osborne from the UK to the mainland late last year, there was a number of announcements, one of which was London-Shanghai Connect. And I think, Charles, we should trademark the word connect quite quickly because it seems to be being used by too many people in too many places around China. So I think I really want to try and focus down on, in this complex world where we're not assured and we shouldn't expect, and on any reasonable basis, exclusivity, where do we see Hong Kong, just looking forward, playing a role? I think you've kicked off some of the ideas around that, but can I turn to Andrew first?
Yeah, I think first of all, let me compliment Jing on her terrific analysis. Jing is a classic example of why, if Lehman Brothers had been Lehman sisters, we wouldn't be in this trouble. Sorry, but I think she brought very detailed industry points into this regard, which is how we got into where we are. The world is in too many silos. We look at the problem from a silo perspective, each of us in our own field. So we want to look at China, we want to look at the stock market. If we're in the bond market, we're going to look at the bond market. We'll look at the capital markets, we look at the sort of derivative markets, commodities markets, but it's also related to the currency. And the currency, as the recent events in China have demonstrated, everything is interconnected. So I think a lot more research needs to be done in Hong Kong, thinking much more holistically how Hong Kong can provide the total package for serving the Chinese customer, and as Charles says, not just the borrower or the company, right, but also the investor. And that holistic means that a lot of research is very important. I mean, what the recent events demonstrated to me was that actually we can learn a lot from the euro-dollar market. The difference between the US dollar as an onshore dollar and the euro dollar as an international dollar. That's exactly CNH versus CNY. Except that the euro dollar and the US dollar is $1 because of no capital controls, but they are two interest rates. Whereas in the CNH, there's a CNH exchange rate, which is different from CNY, and there's also a CNH interest rate, which is also different from the CNY interest rate, right? Now, on that issue, how do we phase in on a stable and prudential manner is the big question for the rest, for not just for China, but for Hong Kong, for the rest of the world, right? And so to a large extent, I think we need much more deeper research at the universities, at our think tanks, to cut across different silos and get this act together, because we are now seeing a live experimentation going on with live potholes, put it this way, right? And it's quite important for us, particularly if Hong Kong is to be the risk manager of Hong Kong, right? Or the knowledge management of Hong Kong, of China, the risk management of mainland and Asia, which Hong Kong was tested during the Asian financial crisis Hong Kong was the center where people hedge Asian risks, and still is the center where it hedges the mainland risks. It has a huge opportunity. So in my view, what has happened in the last 18 months, put it this way, and taken within the perspective of the global financial crisis, is that Hong Kong is now being tested. The challenge is not just to the Hong Kong industry, right, which involves global industry because global industry is here, but also is a learning experience for mainland companies, mainland investors, how we can arrive at a common understanding. What does Keith's 3-point really mean? Can we protect investors from their own greed and fear? This is a crucial question, right? I mean, if we try to protect our investors from every fear, every risk, there's no market, right? Secondly, can we get a truly fair and competitive market in a situation in which the state and central banks have huge implications? Markets are no longer equal markets. They're driven by, I'm sorry to say, 4 lords of finance, 4 central bankers, virtually determining global liquidity or non-liquidity. And then thirdly, where is that kind of liquidity coming from that will ensure that the system doesn't keel over because of liquidity and sudden exit shocks? Okay, so I think if we take that holistic view, then we need to concentrate both on the micro and the macro at the same time because it's a whole systemic issue. So this is a tremendous opportunity. I think Hong Kong now can really stand up to show how we can help manage that risk, which is exactly Hong Kong's role. That we're the intermediation, the window between China, and the rest of the world, and the rest of the world with China. So that role now is not a question of mainland or the rest of the world, but where Hong Kong players, including investors, regulators, and industry, can now put our heads together and solve this very difficult question.
Thanks, Andrew. I mean, just on that, on the question of Hong Kong as a risk management center, I think it is clear in our minds in the SFC when we discuss this issue that so far, given what's happened in recent months in the mainland markets and certainly the nervousness with which the mainland markets look at derivatives and hedging techniques, particularly around the way in which institutional investors were able to access derivatives onshore and retail investors weren't, which then led to what was seen to be unfair outcomes. The opportunity of Hong Kong, I think, for quite some time to be a risk management center for overseas institutional onshore exposure in mainland China is absolutely huge. But just before we move on, Andrew, one question is, I think you mentioned, well, we can look at the universities to do some research. If you had a sort of magic wand and you were in charge, how would you get this done? Because you're saying, I think we need to come out with a total package, which includes the points that Jing was mentioned, bond markets, the credit markets, et cetera, et cetera. The issue for Hong Kong historically, I think, has been that we have tended to be a little bit ad hoc when it comes to our approach to strategy. How do you think what should be the major catalyst to get our thinking together in a relatively short period of time so we can come up with that total package?
Well, there's nothing like a crisis to focus the mind.
Should have another one,
right? And no, I think we've tended to kind of postpone some of these tough questions.
Yeah.
And there is no time like now to do this work. And I think Hong Kong has got the intellectual, financial, and human resources to do this. Right? We're sitting on huge talent. Hong Kong has the huge talent, including mainland talent and global talent, because it's a free market. And now's the time for us really to think this issue's true, right? So I think that either we there is a I'm no longer directly involved, but a proper sort of group of think tanks, put it this way, not a single think tank in Hong Kong that can take this to the next level is absolutely critical.
Charles, how would...
Yeah, I think the key, obviously, here, for us to understand China, essentially our home market. I think it's pretty easy to join the ranks of people to criticize what's wrong with there, because it's pretty clear there is plenty things that are wrong with it. But the value add is not to go and to basically tell them the obvious, because actually the regulators there, the policymakers that are not dumb. They're actually very smart. They know what they're doing. So there's no point to say you have a temperature. There's no point to say you have high blood pressure. There's no point to say that you have a pretty high cholesterol level, you should eat more vegetables, you should exercise more. And we all know that. And if they have done all of that, then they probably don't need Hong Kong anymore. I'm not suggesting that we should be benefiting from their issues and challenges, but I'm suggesting that Hong Kong's unique value is to be there to be able to precisely figure out why the situation is what it is. What are the issues that they have to deal with that very few other people outside Hong Kong necessarily were able to see? Take an example of the Asian market. It's pretty easy to tell them what are the things that we don't like, the way they intervene in the market. But if you truly understand how that market works, they didn't choose to do it to destroy the rules, to make it less transparent, to make it less consistent. It's just because there are certain things we all need to understand, that the way things are run in China put politics, social stability, retail, and regulation, and fully functioning market, full modern commercial weapons of market. They all work together. In a typical market, investors and issuers are being left alone by the regulators who have a certain rules, and then the issuers go into the market, and whenever the market is high, and whenever the market is too low, issuer stays away, and then the investors, all institutions work among themselves on the secondary market. The regulators are able to be reasonably distantly disinterested, regulating as they are like a referees between two players. But in China, that's not the same. The players on the investor side have 80% of them mom and pops. And mom and pops are having a very different relationship with the regulator. The regulator cannot, with the mom and pops on the field, cannot be a complete disinterested referee and be able to blow the whistle. And because when mom and pops are playing on the field, and when other institutions are armed with weapons of modern financial instrumentalities, which are not available to mom and pops, and then you have issuers who constantly come into picking on a market and taking money from a market that is very highly valued because it's a controlled access, the government is always in the middle, trying to help the mom and pops. But the problem is, the mom and pops, without the benefit of all the derivatives and other weapons, will only benefit when the market goes up. So therefore, the government, if the government doesn't want to get blamed for mom and pop's misery, it has to see the market goes up. But the market is not going to go up all the time. So whenever the market comes down, mom and pop lose. When mom and pop lose, the referee is very reluctant to blow the whistle. So it's always going to come in, jumping in between, trying to see whether or not some intervention that can help mom and pops. So that's the reality of that market. But 80% of the population are already in the market. 80% of the market are already retail. You cannot put them back into the boxes. You say, go home. You cannot play in the market. It's already, once people have that freedom, they want to exercise that freedom. So that nature is driving many of the decision formulations of that market. Understanding that the government does not have the option of freely distancing itself. Understanding mom and pops do not have the option of going back home and then leave the money to be managed by professionals. If that's the reality, that over time, and that only take a lot of time eventually to change into a more institutionalized market, which means that periodically, that market will have to be distorted to protect the mom and pop. So futures market is essentially being terminated today. And it's many of the short sellings, many of the IPOs, many of the things that fully functioning market have are temporarily suspended. And it will be brought back at some point, but the next time a mom and pop suffer, there will be another impulse to do something. Recognizing that is the root of the problem, then we can offer something for Hong Kong. Because there's no point telling them what they're doing wrong. They're doing it under a very different narrative, under a very different logic. And what we can offer, as Ashley said, okay, mom and pops can't deal with a lot of those modern weapons. But modern weapons are needed for institutionals, particularly if you want international institutions to be here. Then could you possibly do that offshore in Hong Kong? Then bingo, that's another very critical role Hong Kong could potentially play, helping them achieving things otherwise they wouldn't. The US is not going to do that. The UK is not going to do that. And Hong Kong can do that with huge benefit to ourselves, at the same time, huge value potentially to them. The other is mom and pop. Why mom and pop should only be investing in domestic companies? Why Chinese citizens should not be allowed to own Apple? But Apple is not going to come to Hong Kong, Shanghai anytime soon. Can we do that in Hong Kong? So those are the questions we should be asking, to understanding the problems they have. Renminbi currency, obviously they have political, social, and economic and financial and monetary policies all mingled together. And therefore, sometimes it's going to scale back. So what we need to do is to make sure that we provide enough here for them to manage it. Even though renminbi liquidity offshore is drying up a little bit as of late, but we can offer. So we, for example, in the next few weeks, will be launching a whole cluster of currency futures. We have a currency futures with renminbi US dollar futures. It's trading extremely well now. It's becoming, really big. We're now going to offer renminbi with yen, renminbi with euro, renminbi with rupiah, renminbi with Malaysian region, and also renminbi convert. Right now it's dollar renminbi settled in renminbi P&L. We can also reverse it. Renminbi dollar settled in dollar P&L. Then we also want to launch a gold contract with both renminbi and US dollar. So the cluster of all these currency instruments hopefully create an ecosystem for China to say there is an offshore market that you can trade that determine rates that have certain impacts to onshore, but there's some insulation between China and Hong Kong. So all of the things that we are doing here is to really welcome the era of China's money being played rather than only Chinese companies coming here to play. So that obviously calls for a very different kind of a product mind framework, different kind of mindset for market infrastructures, different mindset for regulation.
Well, on the last point, different mindset for regulation, Keith, as I said, mentioned earlier, is the person who runs a division who looks at the products before they're launched. Keith, very quickly.
Yeah, very quickly. I mean, on the issue of Hong Kong being a risk management center for China, I think that's the value for Hong Kong, okay, going forward, right? I mean, but the thing is, we have to understand our limitation as well. Hong Kong, nevertheless, is a small economy, right? 300-something billion US dollar GDP, and China is the 10, 12 trillion economy. So do you think, I mean, logically, at some point, can we managing the risk flowing from China? So that's a limitation. I mean, would that be a natural limitation for how Hong Kong can perform that role? So we have to be self-conscious of that, limitations. Of course, right now, we still have a long way to go before reaching that stages. For the stock market, for example, I mean, our market cap is around 3 trillion US dollar, right? So it's almost 10 to 12 times of our GDP. This is very unique in the world. That's the highest in the world. But of course, I mean, that's the special situation in Hong Kong. But in terms of risk management, in particular when we're dealing with derivatives and all these things, so we need to be particularly careful to get the right balance.
Yeah, I mean, Keith raises a crucial point, which I think is often ignored, which is that when we're dealing with risk management, we're talking mainly about futures and other sorts of derivatives, and they always give rise to special risks, which are now dealt with by clearinghouses for OTC derivatives, etc. But that in itself, even globally, is a source of major anxiety. The new clearinghouses for derivatives being tagged as the sort of financial Chernobyls, or the effect, or the potential financial Chernobyls. So the way in which we, as regulators, interact with the vision for Hong Kong to be a risk management center, which I personally think is absolutely correct as a direction of travel, is critical. And again, is much, much more complex than the world of H-share listings over that 20-year period. Now,
could I be just for a little bit sparkling?
Yes.
And then Keith can lecture me later.
Yeah, sharing.
London, UK is a small fraction of the United States economy, but nonetheless the biggest offshore dollar center. Is actually the dollar center there is sometimes in many ways larger than the domestic onshore US dollar market. So yes, I agree we need to manage the risk, but the fact that we're small doesn't mean that we have only a small role to play.
Yeah, and that goes back to the statistic earlier on, which is, on relative terms, the size of our financial sector compared to Hong Kong GDP is huge. And there is no problem with that. We just have to be very, very focused on risk management. Now, before we finish, because we're just about, on this clock here, I've got 4 minutes to go. I've got some questions from the floor. Can I put one to the panel? And the only answers I'm going to accept is yes or no. We don't have much time. So the question is, moving forward, do you see the Chinese and global markets glass half full or empty? Chinese and global markets glass half full or empty?
Absolutely half full.
Half full.
All this symbiotic relationship between Hong Kong and China, everyone has to recognize China is very fortunate to have Hong Kong. And Hong Kong equally is the primary beneficiary of having close connectivity to China, right? So I know I'm going not just one sentence answer, but some crucial points here. Hong Kong's advantage, I think, lies in the fact that it is flexible. Remember, when CNH became sort of an offshore RMB currency, the dim sum bond market emerged, right? So many issuers came to Hong Kong to issue dim sum bonds because there was a large growing deposit base, right? Now Chinese companies are going overseas. Many of these acquisitions are done with cash. But if they have listings in Hong Kong, why can't they make overseas acquisitions using their shares as currency, right? Keith's point about Hong Kong, the city's overall GDP, $350 billion. Market cap for the Hong Kong market is over 3 trillion, 10 times. Mainland China's market cap after the fall is only 5 trillion, right? But interestingly enough, the trading volume in mainland China is 10 times higher than Hong Kong. You could argue mainland China is more speculative in terms of their trading activity. Turnover rates are very high. But in terms of market cap to GDP, China is only 50%. Hong Kong is 10 times. Of course, everyone recognizes the unique status of Hong Kong in China's financial reform, financial opening. So I think also there's market inefficiencies. Why I say the glass is half full, just look at the market inefficiencies. That's really what investors can benefit from and make profits from. Hong Kong, China, 2 share classes, A shares and H shares, same companies, same management, same dividend yields, same everything except for the share price. A shares are trading at 50% premium to H shares. So is that fair? Is this market efficient eventually going to go away? So there are lots of interesting questions, Ashley, I believe. So that's why I see the opportunities in front of us. So that's why I think it's half full rather than half empty.
In fact, you just need a bigger glass.
Well, liquidity, right? That's what everyone wants, liquidity.
Good. Charles, I'm sure you're going to say yes.
The answer is yes, because the question is half full or half empty. So the answer is yes.
Yeah. Very well spotted, Charles. Yeah. Good. I think I think from even from a conservative regulatory perspective, I think if I rephrase the question slightly, do you think that the glass is half full? I think the answer from Keith would be yes. Yeah. And I'm sure from listening to Andrew, yes, but we need the think tanks to get together.
Exactly.
Right.
No. Action.
Yeah. Okay. I think I need to wrap up there. I'll just mention that there was I'll just refer to one other question, which I'm not actually going to put to the panel, but I'll just read it out. Ben Bernanke warned in the Financial Forum, which was held here in January, that it is dangerous for China to open their markets before they have an effective regulatory framework. I think that really is relevant to what we've just been talking about. And I would say that the China authorities themselves are not shy of talking about this at all. Back in January, Zhao Gang, who's just stepped down as chairman of the CSRC, said this. He said, "The abnormal stock market volatility has revealed an immature market, inexperienced investors, an imperfect trading system, and inappropriate supervision mechanisms." And he said that in I think it was one of the CSRC regular press conferences. So that's a very high level of self-reflection and honesty, again, which I think is absolutely relevant to the way in which both, industry certainly at the forefront, the exchange as providing the platform and the clearing services, and the regulators cooperating with mainland China can move forward along this line of Hong Kong as being a risk management center for China. So I'll end it there. Could you just please thank the panelists for, I think, a great session.
Thanks very much. Thank you.